Hello everyone, we are live from Chicago. Today is Thursday, October 10th. I'm Charles Brown, Portfolio Manager with CB3 Financial. We are really glad you're with us tonight for the month of ROCKtober. Why do we call it that? You'll know in just a few minutes. If you're new to the program, please subscribe to us on YouTube. Click the little bell so that you get notified whenever we go live or when I upload a video for you to watch. Also, follow me on Twitter. I want to say Twitter. I still call it that. X, Facebook, and LinkedIn. We've got pretty good size audiences on all of them, especially on LinkedIn, so follow us there. These are the topics for tonight. You know many of them. As I said, this is the month of ROCKtober. We'll get into that in just a little bit. And our brand new podcasts, which I guess aren't quite so brand new. We're in the second quarter of them. We started them July 1st. Of this summer. So now we're into October, the second quarter we've been doing these. We're starting to build a pretty good audience, several hundred people watching these, and that's good for a startup anyway. So hope you'll tune in there. They're on Apple, they're on Spotify, they're on YouTube, Amazon, or wherever you get your podcasts. All right. Next show, Thursday, November 14th. This is one of those rare 3 times a year events where there's 5 weeks in between shows. And that's probably just as well because we have an election, as you well know, on November 5th. And maybe 9 days after the election for the show, we might know who the president is. I wouldn't count on it, but it's possible. So the monthly market review. All right, lots to go over here. What I want to say right now is that one of the things we try to do here is educate. We also inform. We also try to entertain. We also try to edify. Those are the 4 E's of this program. And we do it with ease, I hope. Anyway, the point is that during the course of a year, you might think, well, January and February, they're probably about the same. And April and May, they're probably about the same. September and October are next to each other, and they are not the same. All right, so seasonality plays an especially big part in these particular 2 months of the year. And since I continue to get emails, not too many, but people saying, you know, we somehow got by without losing money in September. Maybe we should take the money out now because October is also a terrible month with all the crashes. So let me clarify. It is really important that I clarify, all right? You do not need to be polymathic to understand my programs. Repeating, you do not need to be polymathic. Word of the day, polymathic. I try to do it as straightforward as I can so you guys can get it, and it's important, all right? September, worst month of the year. October, rockiest month of the year. So we finished September, and of course I didn't know this last month when I was doing the show, but we actually had a positive month. It's the only calendar month to average a negative return over the last 98. Let's call it a century, okay? In the last 2 decades, the S&P's declined by an average 0.6. Didn't happen this year. September is often referred to as having the September effect due to its poor performance. But this year, last month, was the exception, or was an exception. There have been some, but not in recent years. All right, so the S&P was up over 2%, its best September in 11 years, and the positive performance, basically financial results. That means earnings. We talk about that on the very last slide of this section, and interest rate cuts. So thank you, Jay Powell and company. It took a while, but Mr. Polymath yourself, I hope that you're getting the message now that the market likes lower rates. So, U.S. equities, where are we doing here? Up 2.02%, strongest September since 2013, bringing the year-to-date return to 2208, and that was at the end of the month. It's a little bit higher now as we've gone 10 days into October. The best presidential election year for stocks in almost 90 years. So you just can't go by a template and say, you know what, September, we just need to stand aside. I mean, look at these asset classes. Bitcoin up 50%. Emerging markets, gold. I mean, a lot of positive movement here. Not so much for commodities. S&P 22 on the year, but September, Bitcoin 8% almost in just September. So I want to state this again. This is shaping up to be the best presidential election year for stocks in nearly 90 years. By the end of September, we had that 22%, the highest during election year since 1936. You can see the bars here, and obviously we can go back almost a century because elections only happen every 4 years. But it's a really good year so far. What about October? Okay, well, so far, October has been positive most of the time, 61% of the time, and October ranks as the 4th strongest month in terms of returns from 1957. But if you just go back 30 years, October's performance has been even better, meaning it's the 2nd strongest month of the year. For those of you feeling like you want to guess, what is the strongest month of the year historically? And if it takes longer than 25 seconds to show up, I'm going to know you're Googling it. So don't do that. Either know it or show it or don't. All right. So the median positive return, 3.7%. It's just been good. All right. And it's just known for its high volatility. It doesn't mean you can't have a good return. It just means you have to go through some stomach ulcers to get there. Since World War II, the average volatility in October has been 35% higher. I mean, take this in. It's 35, not 3.5 or 7.5. It is 35% higher than the average for the remaining 11 months of the year. Hence the name ROCKtober. All right. S&P has had 1% or more swings in October, more than any other month since 1950. That doesn't mean you're losing money. It just means it's stomach churning. Why? Bank panic of 1907, stock market crash 1929, Black Monday 1987. All of these happened in October. Even though September's had more down months, there's been more rocking months in October. So the psychological effect caused by this gets people blaming October and gets people scared. And it also means that the corporate media takes this opportunity to try to scare you. That's why you come to my show. I hope that's one of the reasons that you come, because I'm dispelling all of that tonight. Yes, October can be ROCKtober, but overall it is a positive month. All right? I see Andre's guess. Nobody else, huh? The strongest month of the year. Remember, October is the 2nd strongest month of the year. All right, from 1994. So what would the strongest month be? I'm going to give you another 20 seconds while I'm talking here. What's the strongest month of the year historically, or at least over the last 30 years, which is what we're tracking here. So the Dow, S&P, NASDAQ, top performing month is October with average gains between 0.8 and 1.5 since 1928. S&P's gained an average 0.52. So that looks pretty good. It's just that we've also lost 40 times and, gained 56 times. So it's just not always a fun month to be part of, all right? So it's nicknamed ROCKtober due to the historic market crashes of 1929, 1909, I should have put that on the list, 1987, and a near crash in 2008 when Lehman Brothers went bankrupt. You remember that? That happened in September. The market crashed in 2008, near crash, I should say. October is approximately 35% more volatile than the average over the rest of the year. Surprisingly, though, October has historically heralded the end of more bear markets than the beginning. Read that again. The end of more bear markets, not the beginning of them, all right? The end. Actually, I'm seeing Andre's the only one talking to me here. So, Andre, April is a really good month. It's historically 3rd November, so next month. So we have a good September going in here. If we can have a strong return this month, and of course some of that could hinge on what happens in the election process, we could be set up for a really strong end of the year. I mean like a 35, 38% year. Would not surprise me if things go our way. Got a little bit of a break with the hurricane in that it was still devastating, but did not have a direct hit on Tampa. So I had someone ask me about why is the market, he's noticed that the market has been more volatile during hurricanes and actually often down. And in some ways, you can see that the market is up. It might have a sentiment to go down, but many times during these natural disasters, the market's stronger. And I'll get to that in a little bit later with some questions. So the best time to buy in my lifetime has been at the bottom of 1987. All right. One of the best buying opportunities in the last 50 years. Look at this huge gap. And I don't know if you guys remember October 19th, 1987. Most of you were alive then. And see the big gap down, the big red bar, and then the two huge correction bars there, 3 red bars, and then it's off to the races after that. So this is the chart you guys know and love. I hope you love, I do, because it shows 100 years. It shows 3 secular bear markets and 3 secular bull markets, only because a secular means multiple market cycles. So there aren't that many of them over 100 years. And we are currently in the 3rd secular bull market with an average return so far of 12.13%. Now that is going to rise if this year comes up to 30, 35%, which could happen. It absolutely could happen. Not promising it. Remember, whenever you're investing, past performance is no guarantee of future performance. All right. You know that. So we just started the earnings season, and actually it gets off in earnest tomorrow. So we had just a few companies, 21 companies. We've got perfect in the financials and technology. That will change tomorrow, I'm pretty certain, because about 8 banks, big banks, report tomorrow. And technology, both at 100%. And there's just insufficient data right now. So when I see you in November, 5 weeks from now, not 4, we're going to have a lot better idea on what the earnings picture is. Hey, Debbie from South Dakota. Glad to have you here. What's cooking? All right, here we go, guys. U.S. policy. All right, so I got a little bit of chiding from me going over a little over the top last month with my commentary. I think I balanced it. No one said you were too slanted, Charles, to the Republicans or the Democrats, but you got a little emotionally involved. So I'm going to try to be a little more pragmatic, a little more fact-based. But there is a reality that a lot of people are emotionally stressed out by the markets. I'm going to talk about that in the last slide in this segment. The reason this is so important, and we have to discuss it on every show, is that politics, which we all hate, do lead to policy, which has personal and portfolio impact for us. All right? And there they are for another few weeks. And one of them you will not see much of after this election, I'm guessing, or at least whenever they determine the winner is. So this is how it shapes up right now. Obviously, the red states, blue states, there are 7 swing states. If you don't know them, you should memorize them. There they are: Wisconsin, Michigan, Pennsylvania, North Carolina, Georgia, Arizona, Nevada. All right, 7. Looks like an extra one up there with Michigan, upper and lower, but it's one state. Top issues, all right? The red dots are Republicans, obviously, and the Harris voters, the blue dots. So very important, the economy for both Republicans and Democrats, or conservatives and liberals. Abortion second most for the liberals, as what you'd expect, right? And immigration, much higher concern for the conservatives. It's interesting to me, and I put this on here because the top 4 issues, economy, abortion, immigration, healthcare, are way far ahead of everything else. You can see the tiny little lines for every other entity, from homelessness to government spending. I'm surprised government spending is not so much a big deal to people, but that's the data from the Independent. And this is a pretty good source. Okay, Redfield and Wilton is a pretty good source for these information pieces. This should help Kamala Harris because the unemployment rates right now remain below pre-pandemic levels, except in Nevada. All right, which is actually the least important because it has the least amount of electoral votes of the 7 swing states. Arizona, Pennsylvania, which is the largest. Pennsylvania is really a must-win for both sides, but especially for the Harris ticket. Pennsylvania has the most electoral votes of all these 7 states. This should favor Harris. This should also favor Harris. We have this bump that happened in small business optimism when Trump was elected, the COVID shock, which took it down to a low and then came up a little bit stronger when Biden was elected. And then in the debate here, it's kind of gotten a little bit weaker, but Trump did not get a bump from that. He did not. So if he didn't get a bump, then that means Harris at least got a little bit of a bump. And yet the polling, and this isn't polling, I shouldn't say the word polling, this is legalized gambling on the election. This is overseas because you cannot do that in this country yet. We will see how that plays out. There is actually one brokerage firm, it happens to be the one where you guys are, if you're a client of mine, Interactive Brokers, that is now offering, as of 3 days ago, you can bet on the election. But look here, with $1,577,000,000 placed. That's a lot of money in bets. Okay, and this looking like 53 to 46. I don't know. I don't know what that means, but look at Pennsylvania, looks pretty strong, and yet Michigan, a dead heat. But look at the volatile swings here, and that could be, after their debate. It could be after a certain rally or after Trump said something dumb. It could be anything that's causing this. And Georgia is actually a pretty wide swing. And again, this is the betting market. So obviously, the betting markets can be wrong, but when people are putting their own money on the line, that's a pretty good indicator that they feel fervently about it. And when there's $1.57 billion, it's not just, quarters over bridge with mom's bridge game, right? All right, so I showed you this last time, and I won't show you next month because there won't be a point at that point, but if an investor put $10,000 in the S&P in 1961 and held while the Republicans were president, you'd make $102,000, which is not terrible. But what about with the Democrats? $500,000, okay? But the better solution, the better choice is to take that $10,000 and hold it throughout everything, no matter who's in the White House. $5.2 million. That is a huge wow. Take this in. The reality is, if your candidate doesn't win, the market will go on. The New York Stock Exchange will open at 0830 Central Time, 0930 Eastern, and the futures markets and the currency markets and all of that will open and the economy will move forward. It may not be exactly the way you want it, but this is the history back to 1961. All right. So I've talked about Tommy Else, who's my personal trainer. We worked out 4 times this week, and I am sore, but I am doing my best to be able to manage your money for the next 10 to 15 years, all right? That's what I'm planning right now, and Tommy's a key component of that. Tommy has a professional partner that he works with to do this podcast, all right? Andrea Trippi, pardon me. And so they normally talk about health, and they don't really cover mental health, but Tommy has gotten so much feedback from his own podcast audience that he said, this is something too many people are just devoting way too many hours in front of political coverage and getting upset about it, to the point where 40% of Americans said that politics is a source of anxiety, insomnia, and even suicidal thoughts. I mean, that just seems crazy to me, all right? But clearly we have to acknowledge that this can have serious implications for your mental and physical health. So they're going to do a podcast this weekend. They roll this out every Monday, and I would have just pointed you to their site, but this is so good. I've seen the script, and it's so good that I'm going to put it on my podcast channel. So if you tune in on Monday, normally you'd see me, you're going to actually see Tommy and Andrea talking about political stress. This is really relevant right now as the acrimony continues to be dialed up higher and higher in the last few weeks of the election season. This is not worth your health, folks. All right? Watch this podcast, give them some feedback, give me feedback if it's helpful to you, because they, like I, are trying to bring you good, healthy, educational pieces that are useful for you in your life. And certainly de-stressing from political stress is a big one. All right? So check that out on Monday. The Federal Reserve, oh, J-Pal, you lowered the rates by 50 basis points and everybody groveled at your feet for doing so, okay? All right, the market is now pricing another 225 basis points by the end of 2025. That is not a typo, 2025. All right, and that's good. That means we should be around 3.25%. And that is historically within the mean. Hi, Nellie. Welcome from Atlanta. Glad you didn't get any additional wins from the hurricane passing through there, because you got it the previous week with Helena. So what are some of the benefits of the Fed's current policy? All right. Sustained economic growth and the rate cuts that are designed basically to support continued economic expansion and prevent a recession. All right. We talk about the soft landing. We're going to do it again here. So by lowering borrowing costs, everybody benefits, right? And that stimulates business investment and consumer spending. Now you could say, well, consumers, they just spend no matter what. They'll spend even more with lower rates because most people have a credit card balance, okay? And the rates will follow. Not so much as they would on a business loan, okay? So my line of credit at U.S. Bank immediately dropped when the Fed put their notice out at 1 o'clock. On whatever day it was, the next day I got a notice, hey, your rate has dropped by 50 basis points, all right? So the gradual normalization of interest rates is important. We want to see around 25 to 2026 and around 2027 settling at about 3%. That is a reasonably healthy Fed funds rate. It really is. And it suggests a gradual return to more historically normal rates as opposed to the high ones that we've had, which, as you know, were necessitated by this incredibly high inflation we had. But look at the next point. Ongoing labor market support. The Fed has focused on supporting maximum employment. Why? Because that's their other mandate. So they're no longer focusing on inflation, which means they have pretty much a preset table of how they're going to issue these rate cuts. Are they going to tell you that? They are not. All right? But they're focusing on maximizing employment, which means this part of the balance sheet is clean. We're going to turn to the other side. That tells me that they are no longer sitting there looking like this, like I look in the thumbnail of the show there, okay? And of course, lower rates is going to help sustain job growth and the long term. So inflation, what is the story here? If we're seeing it come down, I know there's a bunch of gibberish on the screen. The black line is all you need to care about. That's the overall CPI month over month change. And from May 21, it is going down. All right, May of 2021, obviously, and then January, you can see the years below that. If you want to, look at other services or goods and services or vehicles or housing, you can. But the main point here is that it is dropping, and that's what the Fed sees. So the annual inflation rate in the U.S., 2.5% for the 12 months ending August 24. Remember that this peaked out over 10%. All right, I'm not going to blame this on Biden. It just so happened to occur during his administration. When Trump left office, it was 1.7. Go back and Google that if you don't believe me. All right, but for whatever reason, and it wasn't just in the U.S. It's not like we're at 10% and Europe's going, hey, we're still at 3%. What are you guys doing? No, it was rampant throughout the world. All right, but it has been dropping. You can see that energy, primarily crude oil and natural gas, to some extent coal and solar, but really crude oil, all right, carbon fuels. They are so volatile And when they're moving up, they start to pull the red line and the amber line, which is food and all items, right? But then when they're plummeting, which crude did, during this period from 22 to 23, then it pulls the rest of the inflation components down with it. So economists are expecting the inflation rate to continue its gradual decline with a projection of 2.3 by the end of the current quarter. Well, that should make the Fed happy because the target is 2.0. Now that last mile, or the last 2 or 0.3% to get to an inflation rate of 2.0, and it's never going to be exactly 2.0, 2.0, 2.0 quarter after quarter. It's just not. All right, but 2.3 is such a huge improvement. That's why I said in the previous section that the Fed has now turned its attention to its other mandate, which is employment, all right, because they want that soft landing, all right? So in the historical context, inflation has moderated significantly from its peak of 9.1. And I get that on the inflation, but there were certain components of this, certainly energy and food, that were over 10%. So when you heard me reference that earlier, that's what I'm talking about. All right. Still, though, key in on this. This is really important. Prices are still 21.2% more expensive since the beginning of the pandemic. So whatever the political talking points are, folks, that's just from the Bureau of Labor Statistics, all right? There it is at the bottom, all right? TACO, which is just a private reporting agency, but the U.S. Bureau of Labor Statistics says that prices are still 21% higher. That is why the economy is such an important topic, all right? For both sides of the aisle when you're talking about it, but 21% higher, I mean, people are paying lots and lots more than they were 5 years ago or 4 years ago for these goods and services, all right? That's going to have to change, and we'll see which of the two candidates can convince the voter that they are the ones to solve this problem. I continue to get questions about when will the recession start. I'm probably not going to do this segment in November and December because I don't really have anything new to tell you. Goldman Sachs is the latest financial firm to lower their 12-month probability of recession from 20 to 15%. Now, everybody's not doing 20 to 15%, but they're not dropping it from 23 to 22.5. They're dropping it significantly, and this is because the outlook is strong because labor is still good. We're going to talk about this in the employment section. There's just a blowaway employment report for September. Weak labor supply growth, which means there aren't that many new people entering the market to work for America, and the overall economic resilience, which is heralded by the American consumer, the biggest economic engine in the world, bar none. All right. So what are the challenges? So motor vehicle lending market showing some stress here. Remember, you couldn't get cars. I had to drive to Alabama to get a car that I wanted. There was nothing in Nashville when I lived there. All right. But we're starting to see signs of stress with rising delinquencies. All right. Now, October's economic data could be impacted by the hurricane and the strike. Well, the strike's over now. It only lasted about a week, not even a week, actually, but it was still a pretty big deal. But it could affect, billions of dollars a day in lost revenue is what happened from that strike. And we'll see if that affects the October payroll numbers. All right. So the conclusion here, basically, the risk of a recession has diminished. It continues to diminish every time I bring up this topic. All right. And that's a good thing. If you're hearing on the major news networks that a recession is right around the corner, change the channel. It's not. When it's going to happen, and I can't predict it to a T, but I certainly know what the signs are, and I know why they're doing it, because they want your eyeballs. You can watch my show or not, but we're not going to enter a recession this year or even in the first quarter of 25. All right, it's going to take a lot more data. It's a slow-moving engine, the engine of recession, okay? The coming months are obviously important. We do want this soft landing. Just making sure you remember from previous shows, soft landing means the Fed is able to ratchet higher without driving the economy into a recession, and then they land the plane, which means they drop rates without exacerbating inflation. That's a soft landing. You have those on jets sometimes. You know what those rough landings are like. We don't want that to be in the economy, all right? All right, so we do the show on the second Thursday. Why is that? Because the non-farms payroll comes out the first Friday. So this is 6 days later. Gives me a chance to process the data. Expected non-farm payrolls, 132,000. I mean, I'm going to call this almost a double, right? 254 is not quite a double, but it sure is close. Adding to this bullishness was the revision. All right, so, and I've explained this to you before, but every month we have a non-farm payroll on the first Friday of the month. We're going to do it, when we get to November. All right, it's going to be the same thing. All right, but what happens is that it gets revised the next month and revised again at the same time as new months are being released. So you start to get what's called a moving average going. And that's what we're talking about right here. So we had a revision to August, which was a bump from 142 to 159. And it's especially helpful because now the Fed is committed to lowering interest rates. I just mentioned the 3-month moving averages of job growth rose to 186,000 jobs from 116 the previous month. I need you to see that again. I'm going to put it on the screen. Guys, we are a healthy economy. And I don't know if that helps the right or it helps the left or it just doesn't matter. But this economy, where we live here in the U.S., is astounding considering there are bombs going off. There are hurricanes wiping out billions and billions of dollars of property. There's always political angst. All right, the U.S. dollar is super volatile, but somehow we're still creating jobs. The unemployment rate decreased, not a lot, but from 4.2 to 4.1. All right. It's still higher, all right, than the 3.8 a year ago, but guys, it's just not that much, all right? It's not that much higher, again, considering all the other extrinsic factors. So what are the economic implications of this, all right? This strong jobs report reinforces the resilience of the U.S. economy and supports expectations of a soft economic landing. And that's positive any way you look at it. I am going to pause and get a sip of water here and look and see if we've got any questions. And I hear you, Andre, about the debt. The problem is that neither candidate that's running for president is saying anything about reducing the debt. This debt will probably be $45 trillion before the next administration is through. Interesting comment from Mark Burns. I like that, Mark. Abortion and prostitution should be allowed at the same time. My body, my choice. All right, that's probably more of a libertarian view, but Rand Paul would like it a lot, I'm sure, and I get that. This show is about economics, so I'm not making comments on social things like this, but certainly it makes sense, all right? It definitely makes sense. Better than the late news. Hey, Nelly and stimulus cash. Yeah, I get it. All right, guys. Any more questions? Just type them in the chat. I'll get to them as I can. All right. So home prices and sales, basically pretty much a similar story here. Okay. The nationwide increase in prices, about 4% from last year. All right. That's great if you're a seller. It's not great if you're a buyer. Median existing home price rose 4.2%. Again, great for a seller, not so much for the buyer. But the sales volume remains low. Look at this. 25 out of every 1,000 homes is changing ownerships. I mean, if you plug that in wherever you live and do the math, extrapolate that out to, 35,000, 40,000 homes, there's just not much on the market. And think about how many real estate agencies there are, and they're all trying to get listings, all right? The lowest housing turnover rate in 30 years. And why is that? Because it's hard to finance a home. And sellers are going, and if I sell this, where am I going to move? And, unless I'm going to go to Mars, probably not going to do that, or go to a retirement home or go on a boat, and just float around the world. But it's hard to refi when you've got a 2 5/8. I know that myself. All right. So housing inventory has been increasing, but it still remains below historic norms. And active listings reached the highest level in nearly 2 years. But look at this. It's still 30% lower than 2019. Guys, this is the same huge seller market that has been in place now for nearly 4 years, since COVID. I would say pushing 5 years, all right? And maybe there's a realtor out there who would disagree with me, but again, it's pretty healthy because it means people are willing to pay up for a home, those that can, but it also creates a chasm between the haves and the have-nots. I get that. I'm not making social commentary, but I am saying that in general, the housing market is pretty healthy, all right? Mortgage rates have dropped now nearly to the lowest level in 2 years, but still not anywhere close to when I was paying 2 5/8. I know one guy that even had a 2.5 mortgage in 2020. All right, but still elevated compared to recent years. Again, because this buyer demand is so strong and they don't have any properties. So it just continues to raise the prices. All right, challenging for buyers for all the reasons I've said. And we're going to see if this rapid price growth continues to moderate. I hope it does. I mean, I want every buyer to make a ton of money on their home, but I also want I want every seller to make a ton of money, but I want the buyers to be able to afford to buy where they want. All right. AI, guys, just continues to blow me away. Now, soak this in. All right. Because so many people seem scared about what is going on with AI and are they going to be displaced? This is an estimate from Perplexity, which pulls from dozens of sources. It's estimated by 2030, that's 6 years from now, 5.25 years from now, that AI will have created 70 million jobs. It will have displaced 20 million jobs with a net gain of 50 million jobs. Read that again. 70 million jobs created, lost 20, net is 50. Do the math on that. Now, I just said we had a non-farms payroll that was producing about 254,000. Let's call it 250,000 times 4 quarters. All right. Or 4 months, I should say. And that's 3 million a year. Okay. So 3 million into 50. You know, we're looking at 17 years to be able to fill these jobs. Who knows what the next technology will be in 17 years? There will be so many job openings that can't be filled. This is just an incredible challenge, but it's going to change the way we function as humans. And I, for one, am really excited about it. I am not concerned about losing my position as a portfolio manager. And there's a lot of reasons for that. If you want to talk about it, CB3 at CB3.com or my number, which you know, all right? But this is really, really powerful, all right? And thanks, Mark, for that comment about ChatGPT. So you'll see Perplexity down in the lower left-hand corner. That has become our go-to source because it allows me to aggregate 5 different chat engines, AI engines, generative AI engines, and have them in one place and pull multiple sources. Sometimes when I'm doing a stock market search, I can get up to 15, 18 sources when it spits its answer out, 35, 40 seconds later. So the 2024 Nobel Prize in Physics was awarded to this fellow, John Hopfield and Jeffrey Hinton, for their foundational work on artificial neural networks and generative machine learning algorithms. When it gets to the point that we're seeing Nobel Prizes, AI has arrived. Can we all agree on that? All right. So this recognition highlights the growing importance of that. And in healthcare, it's being explored to improve care delivery and quality. I don't know if Big Pharma is scared about this, but as a consumer, I am super excited about it because I think it means telemedicine will be just logarithmically increasing, and especially for people in rural areas. We have a lot of clients in rural areas. We saw some last month in South Dakota and Montana, and it's not that rural, but to think that you could have this kind of technology in a reasonable sized city and not have to go to a megatropolis like Chicago is really, really exciting. Okay. We'll see how it plays out, but we think it's going to be helping patients manage all kinds of chronic conditions. All right, how are we doing in the markets? The CB3 methodology. You guys know the 3 programs. I put it here for those of you that are watching or sending to a friend so that they can spend time on this page, understand our strategy. We pretty much believe that everything that you might want to do in the market can be accomplished by a mix of these 3 programs. We think that so much that Alice and I do the exact same thing ourselves. We have since the company was founded in 2004. Understanding stop losses. So we do not just buy a stock and hope. You guys that have watched the show know this, but if there's somebody new watching it, I want them to understand you don't just buy and hope, all right, that it's going to go up and hold on if it goes down. That is not the way it works, okay? We have a 1% stop loss, all right, on the benchmark account, roughly 300 grand. It's actually way more than that, but easy math, all right? That means we'll risk $3,000 on each position. Because the position is a $300,000 account, and the account happens to be in all cash, which never it is, but if, just for easy math, all right, I'm going to risk $3,000. That's 1%. So therefore, the price of the stock has no bearing, neither does the number of shares purchased. It means that I'm willing to risk 1% of the account equity for each position I open in CG and GI. DS has a different strategy, okay? It does not have stop losses. I'll touch a little bit more. I touch on this every time I do the show, but I'll do a little bit more because it really plays out for DS, this latest report, which you'll see in a few slides, all right? So if a profitable stock increases in value, let me just go back and say again, if it does not increase in value and it just barfs on us, sorry, it's gone. It's gone, 1%. That's it. It's gone, all right? But if it grows, then I'm going to ratchet the stop up so that the amount that I'm risking is less than 1%. We're going to continue to further reduce that as the market moves in our favor. Does the market move in our favor on every stock? It does not. Everybody that watches my show knows that, okay? So what is the average win-loss? It's in green there, all right? I don't know if it looks kind of amber to you there and then green. The one that's green is the one I want to highlight right now. The profit to loss ratio, 2.93. We're just under 3%, which is where we want to be, 3-to-1 ratio. You can see the return on winners. And again, just the benchmark account, 162 versus loss of 89,000. Biggest profit was 11,500. Biggest loss, 2,800. Biggest profit percentage, 161%. Biggest loss, 35%. Let me clarify again. I thought you just said you risk 1%. Okay, but the actual asset, the stock can have a 35% loss as long as it's not worse than 1% of the portfolio. Obviously, a $3 stock has a much different impact on the portfolio than a $190 stock. But each of those stocks still has to adhere to the same rule, 1% initial risk, period, no exceptions. Since April 2023, these are the winners, the top losers. We've had a couple join us in 2024, but you can just see 11,000, 9,700, 9,400, 8,700. If you're in CG and you have been some time, you're seeing these same representative numbers. You can actually multiply that number times the size of your account, and it'll roughly play out. If you have questions on how to do that, just call me and I'll explain it. Okay? So here's capital growth. The blue line is CG. This is the CG benchmark account, right at 28% on the year. We were up a little bit higher earlier this year in early July before that downturn, but we're right back there now. And we know that October can be a rocky month. All right. It often is a rocky month, but it has been the second best performing month. And we all know now what the first best month is. All right. Third best April. Best month historically, and that could change this year, but it's November. So it's setting up for a good end of the year. Look underneath the top performers. So Alpine, Summit, and VST, those are the winners, and those are not the returns for the stock. That's the contribution they made to that 28%. So of that, Alpine contributed, we'll call it 4% of the gains, which is why I need my winners to be 3 times bigger than the losers. Look over on the bottom performers. There's not a 1% loss this year. Not a single 1% loss. And why is that? Because I haven't had any stocks just puke on me and they just, boom, go right to the stock and a stop loss and they're gone. So the ratchet happens a little bit. Now they still might come down and be stopped out for a loss, which is exactly what you're seeing there, but it's under 1%. Okay? GI, this program really started out banner strong, and you can see the blue line. It's kind of buried in there, and it's holding up, and it's doing what it's supposed to do. So it's about 55% stocks, 45% bonds, and BLNDX, which is a unique fund which has commodities, foreign currencies, foreign stocks, foreign indices, foreign bonds. All right, it's meant to offset the risk of the U.S. stock market. So let's go back. Let's go back here to Look at the max drawdown here for CG. All right, can you, and I should have highlighted this, guys, I'm sorry. I had to do this late today because there's so much data coming in, I had to process it. But max drawdown, 11%. So those of you that have CG and GI, look at the drawdown here, not even 5% on GI for the year, all right? So what about DS? Well, DS, 15.5% drawdown. So how does that work? Well, as I've said, this has a different strategy than the other two. The other two programs are what Alice and I use, and virtually every client we have uses to build your retirement assets. Most of the monies are qualified. They're not speculative. You're putting the money in here to grow, and as you get closer to retirement, you want to see what something more conservative looks like. GI is the place you need to be. DS is definitely a speculative program. Look at that blue line. And that's why you see the max drawdown of 15.5%. And yet the return is still better than the S&P. You can see the blue line just crossed again above the green line, which is the S&P. So what does this mean? It means that DS is like ROCKtober all year round. I didn't even know I was going to say that before I started. But if you can deal with it, and again, you can only put a certain amount of your money with me and do this. Nobody comes to me with $500,000 and says, I just want to be in DS. Nope, I won't do it. Okay, because I'm not going to take the risk, the legal risk, all right? So we have a conversation, but we are to the point now, this program is 1 full year old. I do have a 7-year track record. I'll show you that on the next slide, but there are only just a handful of us trading it because it was off the block. I thought it was too crazy for clients. And then more and more people, when I started saying, hey, what do you think? You know, now there's like 18 people have it. So look at it. And here's why. This is the 7-year track record. Look at the drawdown, 44.1, and you can see the blue line just nosediving there from January 22 all the way to February of 23. That's a 1-year drawdown, folks. Can you stomach that? You say you can, but can you really? Well, would you do it for a 335% return? Maybe. The point is, understand that this is a speculative program with stellar results. I mean, it's like in the top 3% of asset money managers, all right? So that was not very humble, but it's just the truth. So what you do is, when this program has a phenomenal year, like this year, you call me and say, we're going to go to Alaska. It's just my wife and I are, or my husband and I are, and send us 20 grand, you know, great. I'm happy to do that. Look at the top performers, Microsoft, Apple, Amazon. Look at their contribution to return, 49, 39, 36, huge numbers. And actually the losses are not too bad, 4%, 3.7. All right. All right, any questions about my performance here? You know, just anytime you want to call me. We put it up here so you guys understand it and so that you don't have to be polymathic to understand it, right? You do not have to be polymathic. I want to make it as straightforward and simple as I can so it's understandable, because if you understand it, you'll learn it. If you learn it, you'll embrace it. If you embrace it, you will not be frightened, scared, I started to say, by the corporate media. Okay, so here's the wrap up. S&P showing strong performance in 2024, rising 21% and more now, because that was just at the end of the third quarter. I still see momentum, continued expectation to move forward. I think October is going to be a good month. November traditionally is the best month of the year. We'll see. It could break it there. U.S. economy is headed toward that soft landing. I showed you all that and explained again what a soft landing is. Inflation declining, moderate economic growth. We don't need to have killer economic growth to have a forward-moving economy. Right now, with the market up so high, if we're just growing 0.5% a month, we could be very, very happy with that. And if we did that next year, 12, 14%, there's nothing wrong with that. The Fed has begun cutting interest rates with that 50 basis point cut last month, and expectations continue next month and in 2025. All right. So there we go, guys. That's the show. What do I see here? Like the results, but disagree with some. Mark, clarify that. This is an opportunity here. I'm not sure if you're talking about the performance of the results of the program or the political assessment or what. But always appreciate your guys' questions, okay? Type them in here. I'll stay online, get another sip of water here. But that's the show next month. Remember, 5 weeks between tonight and the next show. We will have had an election. I know that. And we might have a new president. Depends on if those swing states are still counting their votes or we have hanging chads like in Florida in 2000, if you guys remember that. 24 years ago this November. Unbelievable. Definitely follow my podcast, guys. And here's why. Because I do this show every month for you. You can interact with me live. You can see me. Make sure I'm still breathing. All right. But I'm doing podcasts every week, usually 2 of them. One of them is more time sensitive. It's talking about what's happening in the current market, things that are happening, because I don't want to wait 3 weeks or 2 weeks even before I do another show. And then there's another one that's evergreen, like the one that we're going to offer with Tommy and Andrea, more evergreen there with just, political stress and how to handle that. All right, so that's twice a week on that. And then, of course, every day I'm tweeting for you guys. I guess we still call it tweeting even though it's X, all right? So we'll finish we're going to finish the show here with my saying that I continue to believe has empowered me just to have the state of mind that I need to do what I do. For we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. That's 2 Timothy 1:7. If you feel like you need something to bring a little calm into your life, open up 2 Timothy and read the book. It's actually really good to see. Paul's talking to Timothy, his protege, and trying to encourage him. And that's what I'm trying to do here on the show. We really, really appreciate you guys being here every month for this show. Tell your friends, tell your family. We want to bring useful information to you. If you have any comments or questions or criticism, that's fine. We do send that survey out on Monday. It's coming Monday, and you'll be able to ask me additional questions. And just really, really appreciate you guys being here. Next month, big show, 5 weeks from now, maybe a new president, maybe we're still counting, I don't know, but certainly by the December, CB3LIVE will certainly know something then. Anyway, take care. Enjoy this incredible weather. I don't know where you are, but those of us here in the Midwest, the upper Midwest, it's just been phenomenal. A little dry, late on the leaves, but enjoy it. Don't get stressed. Watch Tommy's show, all right? Don't let the politics get to you. The sun will rise. The U.S. dollar will still work. ATMs will still work. Food will still taste like food, no matter who's elected, okay? God bless you guys. Love seeing you here. Wish you the best. Remember, at CB3 Financial, we don't just manage your assets. We become one of them. I'll see you next time.